Commonwealth Bank's Head of Australian Economics, Gareth Aird. Gareth is with me. Gareth, the cash rate a year ago was 0.1%, now 3.6%. The question is whether 3.6% is high enough to beat inflation, to bring it back down into the Reserve Bank's preferred band.
Yeah, good afternoon, Ross. Look, we think it is high enough, but it's really up to what the Reserve Bank thinks. And based on what they did today and then also what they said, they've probably got one more rate hike in the back of their minds that they think they'll need to deliver just to get that rate of inflation down. It's not a done deal, though, whether or not they move again in May. We think they've put so much through that the economy will slow sufficiently this year to actually see the rate of inflation come down, particularly when you couple that with the fact that wages growth is currently consistent with the inflation target, which is a good news story. But ultimately, it's going to come down to what the Reserve Bank thinks. The next inflation print, which is the quarterly one, will be a key input as to what they do in May. And if they think they need that extra rate hike to bring it down, then they'll deliver that.
So in your note today, you basically said that forward guidance has shifted to a dovish direction and 3.6% may be the terminal rate in this cycle. But you've got a sense that there's one more rate hike, don't you?
Look, we've got a sense there's one more, but I wouldn't say we've got high conviction on that. We did think they'd pause today because if you go back to their communication over recent weeks, I think they were hinting that they really wanted to pause today, and that's what they then delivered on. But given they've got that what we call a hiking bias, where they're still saying if they're going to do anything in the short run, it is to tighten policy further and lift interest rates higher. We've kept one more hike in our profile for May. But look, I think it's line ball. I mean, we're there or thereabouts in terms of the top of the interest rate cycle. So whether or not we get one more 25 basis points is not a massive deal in the scheme of things. What is a far bigger deal is that the RBA has increased the cash rate, as you said, 350 basis points since May of last year. That tightening still has a fair way to work through in terms of the household sector, particularly for all those borrowers out there who are on very low dated fixed rate loans that are rolling off this year. They're going to step up to a much higher floating rate loan or fixed rate if they do that again. And that will basically mean that there's, in effect, ongoing tightening coming through the economy, irrespective of whether or not the RBA is still raising the cash rate. If they leave that rate on hold as we go through this year, what we'll see is the economy continue to slow as those fixed rates roll off.
I was going to ask you one question because the Reserve Bank was slow to start raising interest rates and to acknowledge inflation was a problem. It was the first to taper rates around the world of all the major Western central banks. And now it's the first to basically say it's got an on-hold strategy for interest rates. Why is the Reserve Bank, why is Australia's economy different to others around the world?
It's a good question. I would say it's not so much that our economy is different. It is rather that the mortgage market is different, and therefore the way interest rate hikes work here in Australia means the Reserve Bank gets so much more mileage out of their rate hikes because we're predominantly a floating rate mortgage, or for those borrowers that are fixed, they're not actually fixed for that long. So what you get is a much more direct transmission mechanism between the cash rate, which is the Reserve Bank's policy rate, and the mortgage rate, which impacts home borrowers. Whereas if you look at the US, for example, home borrowers in the US are on these very long dated fixed rate loans. So when the Fed moves, it doesn't actually impact an existing home borrower. So what it basically means from a central bank perspective, if you're comparing us to others around the world, we shouldn't need to go as high to get the same impact in terms of slowing the economy. That's why I think the RBA was the first of the major central banks to step down the pace of tightening in October last year, and I think that's why they've lent into a pause today.
Okay, so let's go to Australia and this fight against inflation, because it seems to me that there are still inflationary pressures out there. Oil prices rising to $80 a barrel in the past couple of days. The wages claim from the ACTU at 7% and the government following in saying it should be around the inflation rate. You've also got other things, including energy prices still rising for households and businesses during the course of this year. So it's not as though there's not inflationary pressures out there. What are the things that are taking the pressure off inflation?
Yeah, look, good point. There will absolutely be some inflationary pressures within pockets of the economy this year. And the other thing too is that rents are going to continue to rise at a pretty decent pace. But yeah, rents, because home building's actually coming off because of the interest rate hikes. And then with very strong population growth, you've got an incredibly tight rental market, and rents will continue to rise as we go through this year. Where we think the disinflationary pressures will come, and in some pockets outright deflation, in other words, price falls, is in parts of the consumer discretionary basket where households are going to have to rein in spending in order to meet the higher mortgage repayments, and therefore businesses in those sectors won't be able to get away with continuing to put up prices. And we think in certain parts of the retail sector, you'll actually see some discounting, particularly given shipping costs have come right down. Some of those input costs for businesses have actually fallen. And we think that means that as demand slows in the economy, because of the rate hikes, you'll see disinflation in a range of parts of the basket. So with the CPI, you always get some things that go up, some things that go down, some things that crab sideways. All up, we think what will happen is we'll still be getting inflation as we go through this year, but that rate will come down. And if we're right, and this is a big if, but if it's coming down quick enough, we actually think the Reserve Bank will be cutting rates at the back end of this year, simply to avoid the unemployment rate going back up to the kind of levels it was at pre-COVID.
Okay, so much is put into the language of the Reserve Bank governor. I think we can put up here one of the key quotes that he put in today, basically talking about the fact that, there are more, they're leaving open at least the scope that interest rates could rise. Here we go. The board expects some further tightening of monetary policy may well be needed to ensure that inflation returns to target. The decision to hold interest rates steady this month provides the board with more time to assess the state of the economy and the outlook in an environment of considerable uncertainty. So they've left the door open, but as you point out, that language needs to be interpreted effectively. The Reserve Bank is saying, well, if we're not there, we're pretty close.
I think that's exactly right. I mean, I think it makes a lot of sense in the short run to leave the door ajar to raising rates more, because if the Q1 inflation data comes in stronger than they're anticipating, they'll feel compelled to raise interest rates. So, in fact, what they did today was in line with what we called, which was to leave the policy rate on hold, but basically retain what we call a hiking bias. In other words, just say, look, we might have to do a little bit more, and that's what the governor said today. Gareth, I've got to jump in there. I do apologise. We just run out of time. So many thanks for your time today. Gareth Aird from the Commonwealth Bank there. No worries. Thanks.